Okay, hi everyone. We're going to be doing the lecture here for Chapter 2, the PowerPoint. This chapter we're talking about worldwide accounting diversity. So things we're going to look at in this chapter, showing us some examples of accounting diversity, looking at the causes and reasons for this diversity, and then problems that arise by virtue of having accounting diversity. We'll be looking at a couple of different financial statements from different companies and showing these differences. And we'll talk about kind of the history of what has gone on between the different accounting systems, movements that they've made, where they currently stand. Overall, what we're working towards right now, right, is just trying to reduce the complexity between GAAP and IFRS. So, in the US, we use GAAP. In other countries, they use IFRS. So, as I have here, right, various differences exist when trying to compare financial statements from different countries. Right off the bat, right, just things, if you're looking at it, names, titles, terms differ. You're not going to be able to have an apples for apples comparison looking at two different financial statements. Likewise, even if you do have a cash account or something where you can say, okay, that makes sense, that's the equivalent of the cash on the US, that's simple enough, it doesn't necessarily mean that the accounting treatment for it was conducted in the same way. In other words, there could be different accounting rules that are used. So let's look at an example here with Verizon and Vodafone, a US and a British company, respectively. We're going to look here at their functional equivalent of a balance sheet. So we have Verizon on the left, Vodafone on the right. We can see, right, that they both have assets, liabilities, and stockholders' equity. They're going to have a different name for this financial statement. So in the US, they call it a balance sheet. In Britain, they call it the statement of financial position. Likewise, the order here isn't the same. In the US, we have our assets, our liabilities, then our stockholders' equity. Whereas in Britain, for this company, they have assets, stockholders' liability, or stockholders' equity, and then liabilities. So, the ordering is switched up a little bit. And then things like assets, for example, here we list them from most liquid to least liquid, namely how quickly you can convert this account into cash, where the reverse is true on the British financial statements. So doing a zoom in here on the British financial statements, right, we can see that, this is like the functional equivalent of a balance sheet, but some of these accounts we may not have ever seen before, right? Like, what does this mean? Shares in group undertakings. Well, if we were to investigate that, right, that would be the equivalent of an investment in a subsidiary on the US financial statements. Things like debtors and creditors, right? That's like accounts receivable and accounts payable. Other items there, in the stockholders' equity accounts, we have the functional equivalent of common stock, APIC, retained earnings, treasury stock, appropriated retained earnings. You can see here, right, that both are a balance sheet, but how it's presented and the terms they use are different. So if we were to look at reasons for why we have this accounting diversity, right, it includes things like the legal system that's in play, taxes, how the business is financed, inflation, as well as politics. So let's kind of run through these different explanations. So the first one that's going to explain why we could have different financial statements would be the legal system within which the country is preparing or operating, preparing the financial statements or they're operating. So when you're looking at different legal systems, you really have common law countries and you have code law countries, the US being a common law and other countries, specifically those in Europe, many of them are code-based or code law. countries. So in common law countries, you have statutes which are then interpreted by case law. Accounting rules here tend to be delegated to the profession, right? Like the US government isn't making accounting rules. They say, hey, no, we're going to delegate this to the FASB to make GAAP, right? And they have those accounting standard codifications, the ASC rules. Likewise, here the rules tend to be more detailed, supported by guidance when they make these accounting rules. Now, in code law countries, right, for example, Germany, all of the accounting rules are statutory, right? The actual government itself is making the accounting rules. They're created by the legislature, and they tend to be more general, right? Broad-based, and then they're going to rely on secondary sources to help interpret them. Second reason here why we could explain diversity is taxation, right? Some countries, for example, require that whatever financial statements you publish, you also have to use those for tax. So for example, Germany had previously required reverse conformity, holding that a deduction for tax generally has to be taken on the financial statements. Whereas other countries, right, like for example, here in the US, when we're doing taxes, you may start with financial statements, the books and records. Then you would make adjustments to this. So they're like book to tax differences. If you remember tax class, it would be M1 adjustments. So for example, like muni bond income, this would be taxable on the financial statements, but not taxable on the tax return. Third, another reason here would be financing, right? So we have private versus public financing. So this would help explain how you prepare your financial statements, why there would be differences. If you have private financing, this is where the financing comes from families, banks, or the states. Now, when we say financing, what we mean here is like, how did we get the money to run the business? How did we finance this? And with private financiers, there tends to be a greater connection with the business between the people who are financing it. So, for example, somebody who's a big stockholder could be on the board, right? And because it tends to be more privately focused, there's going to be less of a requirement for external disclosure, right? Whereas with public financing, which many of the big companies in the U.S. are, right? Like you would buy a share of Apple, a share of Amazon. Financing comes from the general public, whether it would be a bond or stock, and they would be outside external investors. And in this case, right, we would have to have more disclosure because we're dealing with the general public, right? That's why we have the SEC, why they require the 10Q, the 10K. We need to disclose a lot more information. Fourth reason here is inflation. So, this could affect how you prepare the financial statements. Basically, countries that have very high levels of inflation, right, they have to adapt their accounting rules to reflect this fact. You can't just have it necessarily on there at historical cost. If, for example, the inflation is going up 50%, 100% a year, right? In these cases, a lot of times what happens is countries with high inflation, they'll kind of depart from that historical cost principle and will allow non-monetary assets, so things like inventory, to be subsequently written up to their fair market value. Now, in distinction, countries with relatively lower levels of inflation, we're normally going to adopt a historical cost principle. So what you bought it for is what it goes on the balance sheet for. We're not going to generally, we're not going to rewrite it up. We're going to keep it on there at historical cost. So continuing here, right, politics also come into play. Right, so as I have here, right, the formation of a country and the influence of external nearby countries can influence an accounting system. So, for example, as I have here, previous French colonies tend to have accounting rules that are similar to France. Okay, that makes sense, right? If you were once ruled by France, it might make sense that you carry over those concepts and traditions of accounting. Likewise, right, if you're in the EU, all 27 countries there have adopted IFRS. So, what your government says, or how you're connected politically, or the historical context, that can all come into play for how you prepare your financial statements. So, there's been, accounting academics who've looked at this, right? We have the Hofstede and the Gray model here. One of the reasons, they're looking at cultural dimensions, things like power, distance, uncertainty avoidance, individualism, masculinity. Um, and Gray here, he applied these cultural dimensions to accounting values to help explain it. So in accounting, right, we value professionalism, uniformity, conservatism, secrecy. Uh, in short, right, and I'm not going to go down the rabbit hole of accounting academics, studies have found that cultural values affect the application of accounting rules. So the culture you live in can certainly affect how you present and prepare financial statements. Now, what are some of the problems of this accounting diversity? Right? Well, we have things like, how do we prepare consolidated financial statements? How do we gain access to foreign capital markets? How can we compare financial statements? And because of all of these differences, hey, we may lack high quality accounting information to make decisions. So first one here is preparation of consolidated financial statements. So imagine you have a US-based company who has a foreign subsidiary, right? And you would have to consolidate those two financial statements into a single financial statement. How do you go about doing that, right? Because maybe the foreign sub, they have a different accounting system they use, a different dollar amount. Basically, the long and the short of it, we'll look at this more. We'll have a whole chapter or so dedicated to it. What we're going to have the parent company do here is translate the foreign subsidiary into the home country denomination and then convert them to the home country accounting rules. So we kind of bifurcate it. We look and we say, okay, how do we translate this over into US GAAP? And then after doing that, or another item we need to address is, how do we convert this from maybe euros to USD, right? What exchange rate should we use? Second idea here is foreign capital markets. So, hey, we're a US company. We want to be listed on the stock exchange over in Europe. We can't just use our US financial statements. They're all IFRS over there. So what do we have to do here, right? This can cause problems if we're trying to get into these foreign capital markets. So as I have here, right, companies who want to borrow or sell stock in other countries have to provide financial statements using those rules. So a German company using IFRS who wants to access the US capital markets, they could have to provide a financial statement using GAAP. Second issue here is comparability. We looked at this, right, with the two balance sheets. They're similar, but trying to compare them, it's not really easy to do at first blush unless you have some background or context in it, right? There's different names, different accounting standards. This can make it hard to understand. So as I have here, right, if you're a U.S. investor, you may not be interested in investing in anything overseas. Yeah, sure, you can show me those financial statements from an overseas company, but I can't reasonably interpret them to make an informed decision as to whether I want to invest in this business. So comparability is an issue. And in the same vein, right, we can have a lack of information. Right? There's a lack of high quality accounting information. So basically, there's no unified standards here, right? Generally we have GAAP, generally we have IFRS, but it's not like we have one set of rules that can help guide us. So again, we can't fairly assess risk if we're looking at companies outside of our home jurisdiction because we'd be unfamiliar with those financial statements. So in studying accounting diversity, right, there's going to be various ways we can classify the accounting systems. We can look at it one way and classify it by like a fair presentation or full disclosure model. So this is like what we do in the USA, right? We want to have fair presentation, make sure we disclose as much as possible. We can have a legal compliance model. So this is generally used in code law countries. So hey, the law will tell us how we have to prepare and show our financial statements. Or we can have an inflation adjusted model. It's similar to fair presentation and full disclosure, but it's really going to factor in high inflation. We have to adjust for that. So it's a fair way here of basically saying, in a very high level would be like US versus Europe, right? GAAP versus IFRS, fair presentation, full disclosure versus a legal compliance. The first of those being modified if you're looking at like a high inflation country. So that's one way you can do it. There's also this NOBS model, which divides it into two types, Class A and Class B countries. So in this case, Class A countries would have like strong external financing, right? The US, Apple, Amazon, they have a bunch of strong external financing, many stockholders. There's going to then be Class B countries where there's weak external financing in continental Europe. You can look here, right? Some, A has more less conservative measurement rules. The accounting is going to differ from tax, whereas B is going to be more conservative, and accounting is going to be similar with tax. So just another way to classify it, right? It would be like if you were classifying football teams, maybe one way you could classify them is by division, right? What division they're in. Another way you could classify them is by whether they have a winning record, right? So it's still the same 32 football teams, it's just different ways you sort them. So the rest of this chapter here, right, we're going to be looking at other specific instances of accounting diversity. Things we're going to be looking at are differences in financial statements in the annual report, formatting, the level of detail, terminology that's used, disclosures, and then recognition and measurement rules. So if we were to look at like the annual report, right, as I have here, both GAAP and IFRS, they're traditionally going to require 4 financial statements, right? You have the income statement, the balance sheet, statement of owner's equity, and statement of cash flows. Now, the names of these might be slightly different between countries, but functionally, right, we're going to be looking, that's how we prepare it, right? Wherever we're at, going to be different accounting rules, different names, but functionally they're the equivalent of it. And some countries, right, they're going to have country-specific rules. So they may have a 5th or a 6th financial statement. But for right now, let's just assume that we're going to deal with 4 financial statements, right? And like I said, the latter 2 lines here, they're going to talk about an Austria company and a Brazil company where they include those other statements, right? So 4 is traditional. Depending on what country you're in, you may have 5, 6, 7, 10, 20. It's all a function of the country you're in. This is looking at like the value added statement, right? This is an interesting thing, right? We're looking at, they're requiring a value added statement here that looks at the groups benefited from the company's existence, including employees, financial institutions, and stockholders. So this is kind of like the do-good statement, right? What are you doing for the community? What value are you adding to society? Well, hey, here's the value you're adding to employees, to financial institutions, right? You're creating jobs. You're helping the economy, right? We don't really do this in the U.S., right? So this would be country specific, but the whole point of this chapter of this textbook in general is just to show you some of these differences. Nobody's going to expect you to remember line for line, hey, the Brazilian value-added statement. But being aware that there are more than 4 financial statements in other countries would be an important concept to know. The next one here is formatting, right? So we showed the Verizon versus Vodafone. So the balance sheet, right, we're going to list it, our assets in order of liquidity, most to least liquid, and our liabilities based on maturity, the soonest due to the latest due. Other countries like Canada, Mexico, Japan, they're going to have a similar formatting to this. However, other countries like the Vodafone, right, they could be the reverse. I say this because, like I said, when I was in practice and I did international tax, there were times where I had to look at foreign financial statements and I was a little bit disoriented at first. It's not always going to be the same. It would be like if you ever have traveled abroad or anything like that. One way somebody described it to me, and I thought this was kind of accurate, it was almost like you woke up and the colors changed. Right, everything's still the same, right? I can still look out and see this, and the sky is blue, and the grass is green. But if you go to a foreign country, right, it's not literally going to change, but the metaphor of it, it's a little bit disorienting. It's like, yeah, there's the sky, there's the coffee shop, there's the school, right? It's similar to, but it's just a little bit different where it throws me off and it disorients me because maybe it's labeled differently or the setup of it is differently. So I say this, formatting could be different on top of additional financial statements. So for the income statement, right, traditionally we're going to start here with our sales minus our cost of goods sold, gives us our gross profit. Other countries, so a lot of times in Europe, they're going to do the income statement by the type of expenditure approach, where basically you break cost of goods sold out into further components. And as I have here, right, most companies follow an ordering sequence of sales, then operating income, then pre-tax book income, then net income. Isn't always the case exactly, right? But if you remember learning about the income statement, right, there's kind of stop signs as you go through, right? It's like, tell me your operating income minus your operating expenses. Your operating revenues minus your operating expenses gets you your operating income, stop sign. Then you can back out, your other expenses, your other income. Get to pre-tax book income, back out tax expense, get you to net income. So this is just showing you here, right, how we have a US, a German, and a Spanish company. One just has cost of goods sold. The other one in Germany here, they break that cost of goods sold out into different components. And then the Spanish company here, they're going to take a different approach to presenting it here, their income statement. So another thing to be aware of, right, when you're looking and you're comparing different financial statements is the level of detail that's required. So in the US, right, our financial statements tend to be more general, right? You can look at the balance sheet, check it out. If you're kind of an accounting nerd, right, you may look at the detailed information in the footnotes, right? So it's kind of like a clean, 1 or 2 page balance sheet. If you want to know all the rules and stuff, go look at the footnotes in the back, right? Whereas in distinction, other countries, they're going to have a much more robust financial statement, a lot more details up front. We really want to expose you to this and make sure you're seeing it. We don't want to just bury it in a footnote. So again, this is just something to be aware of. Right here, in this case, right, we have, as I have here, right, for example, Callaway Golf in the US has 3 operating expenses in their line items, whereas this Thai company is going to have 15 operating expenses right here. Just more level of detail, right? It could be in what's presented or how we break out the accounts. Instead of lumping it all in one, we would specifically break out each of those items that comprise it. So it's kind of almost like total versus all of the items that comprise the total. Some countries want to see all of the items that comprise the total. Other countries are fine with just telling us the total, right? Next one here, terminology. We looked at this, right? So for example, when we looked at the Verizon financial statements versus the Vodafone, in the US, right, we call it an account receivable. But in Britain, they call it a debtor. So it's all a function of the country you live in, the rules you have. Don't assume, here's one thing, we've talked about, okay, there's differences. AR means this, debtors means that, they're functionally the same. A different twist on this is when you may have an account that has the same name, so account X on a US return and account X on a Britain return, they're named the same thing, but they could mean different things. So that's why you have to really be careful when you're reading and interpreting financial statements that you are familiar with that country and familiar with the rules. Next one here are disclosures, right? So we talked a little bit about footnotes, presentation, right? The level of detail. Now, with regard to disclosures, right? Some countries can require certain disclosures. Laws say you have to disclose A, B, C, and D, right? On top of that, in those countries, you can voluntarily disclose other things like F, G, H, I, right? Basically, it's country specific. The laws that determine how much disclosure, maybe in the US you have to disclose A, B, and C, but in Europe you have to disclose A, B, C, D, and E, more disclosures there. It's country specific, right? How much you're telling the investors, the financiers, what you're showing the financial statements is a function of the country you're in. So for example, the Sweden company here, they're going to have a detailed footnote concerning the number of employees, their geographic region, and their pay. The Netherlands, for example, they're going to have a footnote that's required to help explain the provision as well as the non-current liability section of their balance sheet. So this is what these countries value and what they see as important that's required to be disclosed under the country's laws or the accounting standards. This is just showing you, some of those countries. So another area here, the last point or two, different rules in recognition and measurement. So recognition, if we're talking about it, it says, hey, what needs to be recognized or reported on the financial statements? It's kind of like transaction analysis in financial accounting. If you remember intro here, it's 281. An event happens, buy a vehicle for $200 cash, right? That's a recognition event. It's something that happened in the business that we need to do a journal entry for. Measurement would then tell us how much do we put that on the balance sheet for. So hey, maybe historical cost, right? So these rules for whenever you have recognition, something that happens that requires you to do a journal entry, report it on the financial statements, as well as once you realize you have to report it, at what amount, measurement, they can differ between countries. So, for example, we have 3 PP&E models. So PP&E, right, this is property, plant, and equipment. You could have historical cost, you could have historical cost adjusted for inflation, or you could have fair value. Let's look at a simple example here, right? Say we buy a $10,000 fixed asset. Hey, we have a 40% inflation rate each year. And at the end of the year, the fixed asset has a fair value of $15,000. So if we were using historical cost, right, let's just say it had a 10-year life, we were equally depreciating it year over year. At the end of year one, you'd have it on the books, you'd have 10,000 minus 1,000 of accumulated depreciation, right? The net book value would be 9. This is GAAP, right? That'd be historical cost. However, if you used historical cost adjusted for inflation, we'd have it there for 14,000, so the 10,000 with the 40% on top of it, and then we would take 1/10 of that for depreciation, so $1,400. Whereas finally, right here with fair value, at the end of the year, we'd have it on there for 15,000. It's fair value, and we take 1/10 of that for the depreciation expense. So that's going to wrap up this lecture. Again, this is just high level, right? You're not going to need to specifically memorize line by line foreign financial statements. Don't worry about that level of detail. You know, we're talking about level of detail, so I'm going to tell you a little bit about level of detail. Don't go that far here for it, right? Your best bet is to work through those problems, and that will give you like a fair analysis of what would be reasonable for the exam. So we'll see you in the next chapter.